All right. Good evening, everybody. Thank you for joining our webinar today. And we hope that you enjoy the information we're going to provide. My name is Kenna Parham, and Terry Parham and I will be co-presenting the information tonight. So we hope that you find this valuable. We waited a few minutes to see if anyone else would join in. So we'll just kind of go ahead and get started. And then I'm sure people will start to join in as the time goes on. So we'll go ahead and jump right in. We always want to start off with a disclaimer slide. Of course, we are a registered investment advisory firm. We do not give specific types of advice when it comes to these types of presentations. These are all about educating you, giving you the best information, the most recent updated information on the topics that we present, and just making sure that everyone that's on this webinar is getting what's most out of these presentations, which is really just talking about the topic at hand and answering any questions that you have. But when we go through the presentation today, we always like to start off by saying we aren't going to be giving any specific advice, but just giving general advice and doing as best as we can to educate you. Like I mentioned, my name is Kenna Parham. I'm one of the founders and owners of Innovative Wealth Building. Terry Parham, as you probably know, he always does most of these webinars, and I try to jump in and co-present with him when I can. We are both financial planners with Innovative Wealth Building. Two of the four financial planners and owners, Warren Brooks and Jennifer Hill, being the other two. And we're happy to be here today to continue to provide the best education we can on various topics. So we'll go ahead and jump in and get started. Today is all about life insurance. I'm not sure if many of you know, but September is Life Insurance Awareness Month. So we thought there's not a better time or a better month to go ahead and talk about this and utilize it as a good opportunity to just touch on the high points and some of the most important topics regarding life insurance. So we're going to be talking all about specifically life insurance today, the important parts about it, and hopefully some of this pertains to your situation. So I'll go ahead and jump in. I'm going to do the first half of the presentation, and then I'll have Terry jump in and cover the last half. We're really going to talk a lot about life insurance basics. When we talk about a lot of topics, we want to make sure that we start off on a high level and giving you just the most simplistic viewpoint of the topic, and then we gradually build to a little more complex knowledge, but we're still going to keep it simple. We're going to try and explain it as best as we can. So we'll talk about life insurance basics, common pitfalls people run into when it comes to thinking about life insurance or planning for life insurance for their family, and then just overall best practices that we've seen as we've worked with families over the years and helped them implement strategies that best fit their situation. So I'll start off with a couple interesting statistics. I found these as of recently, so they're up to date as of 2022. The first one says 44% of American households would encounter significant financial difficulties within half a year if they lost the primary wage earner in their family. So 44%, almost half of American households, would struggle and encounter some sort of financial difficulty within 6 months of losing their primary income earner in their family. I think that's a pretty substantial and a powerful statistic, because it really shows you that life insurance is a thing for a reason, and it's specifically designed to help people, combat those problems when somebody who's the primary breadwinner of the family has a premature death or passes away. It's really there to supposed to help, take the weight off of and the burden off of the other person trying to carry forward financially. So 44% is a pretty decent number. And then even below that, 28% would reach this point only in the first month. So as we talk today, just keep that in mind. A lot of people, life insurance is going to make sense for their situation. It's not for everybody, and every product and every type is not for everybody. But for most Americans, it's typically going to be in their best interest to take a look at exploring some type of option for their family long term. I have one more interesting statistic. This is according to it's in 2022, the Insurance Barometer study conducted by LIMRA and Life Happens. It says 106 million adults lack life insurance coverage or adequate coverage. So another interesting statistic that they said that basically the need gap, what people have right now versus what they think that they need for their family, is at an all-time high as of 2022, and it's more than doubled from what it was 12 years ago. So I believe that the need has been increasing over the years. People are realizing there's much more of a bigger need to cover things that they care about and protecting their loved ones. And this just really speaks to the volumes of how life insurance can benefit your situation if you feel like you're in this boat or in this situation. So I'll start off with this before we jump into the basics. I like this picture because it really just depicts and displays that life insurance, when we think about purchasing it for ourselves, essentially we're getting a policy on ourselves, but we're paying for it not for our own benefit. We're paying for it for the people that we care about. So whether that's you're a child, a spouse, a grandparent, a niece, whoever it is that you care about leaving money to, or that you want to leave money to, or that actually depends on you to continue their lifestyle, paying for life insurance really is for them. So it's definitely a selfless thing when you think about actually getting into a life insurance policy and thinking about planning for your family. It's very selfless, and it's really not for us specifically, but it positively impacts the people that we care about. And that's the biggest component of why people really utilize, the main reason why they utilize life insurance. So let's go ahead and jump into the life insurance basics. I like to start off with it very simple. What is life insurance? Life insurance is really just a contract between you and the insurance company. Basically, they say, hey, let's see if you're healthy enough. Let's take your age into a factor, how much coverage you're looking at getting, and then you'll pay a premium based off of how healthy you are, your medical history, your background, your current employer. There's many factors that go into deciding whether or not the insurance company is going to insure you and at what rate they think that they want to insure you at. So you enter into a contract and an agreement with them, you pay the specific premium that they're offering you. And then as long as you pay that premium, and as long as you're paying up the premium as to current, when you pass away, they often will give you they'll give a death benefit that's paid directly to the beneficiary upon your death. So it's very simply put, contract between you and the insurance company. You pay a premium, you get a great benefit out of it that's tax-free in most situations. Now, we're not going to go into detail on each specific type of life insurance because there's way too many out there and they all work a little bit differently. But this is just a good picture that shows you there are a lot of different life insurance coverages out there. There's traditional temporary coverage, there's universal life, whole life, which some of you may have thought about or have heard about in the past. There's survivorship, single life, variable life, which a lot of those run under the permanent family of coverage. And it just goes to show you that there's a lot out there about life insurance, and it can feel complex, it can feel overwhelming, and sifting through the best one for you can be tough. And so we're going to talk a little bit today about what it means to take a look at the different life insurance policies and how you want to utilize life insurance for you and your family. But don't let it overwhelm you too much, because we're going to cover today just the two main types and keep it very simple on the differences between the two main types of coverages that people typically look into or typically get into a policy with. So we're really going to just compare and talk about term life insurance, which is temporary coverage, versus whole life insurance or permanent life insurance in general. So we'll start off with temporary coverage. A lot of people call this term. Really, temporary coverage is designed for those years where you don't think you'll need the coverage forever, but you do want to have a substantial amount that's going to provide some decent benefit if there were to be some sort of premature death. So this covers you for a specified period of time. So sometimes people will get into policies where they'll do 10 years, they'll do 20 years, 30 years. I would say 20-year term is probably the most popular I see, with 30 being second, because people typically will get temporary coverage to take them out to retirement, and then they'll be fine with the policy going away at some point. So temporary coverage really allows you to get a specified amount of time where you're covered, and then the policy will go away. Like all insurance companies or all insurance types, the insurance company will pay out the benefit tax-free to anyone that's on your beneficiary upon the time of premature passing. And then in these situations with temporary coverage, there's usually no bells and whistles. It's a very straightforward policy. You pay a premium, you get a death benefit if you pass away, but there's no cash value that's running for you. Your premium is 100% being paid for the coverage and nothing else. So there's no investment component. It's just paying your premium, and that's all that it's paying for. And in most situations for temporary, almost all, premium is fixed until the end of the term. So if you're 30 years old and you get $1 million policy and you pay $55 a month, by the time you're 60, if you get a 30-year term policy, you'll pay $30 a month until you're 60, or $50 a month until you're 60. And then when you turn 60, if you didn't use it and you outlived it, that's great. It'll go away and you won't continue to pay for it if you choose. But on the other side of things, if you do choose to keep the policy, you can renew it, which typically when you renew it, it's way more expensive than it was when you got it when you were 30. And you also can think about potentially converting it. So sometimes people will get temporary coverage initially because they don't think that they want to get into a permanent long-term contract. And then they'll potentially consider a convertibility option in the future, where they'll convert some of the life insurance, temporary life insurance that they had, into more of a permanent policy. So without getting too much in the weeds on that, the main points is that temporary coverage covers a temporary amount of years, a temporary amount of time, and there's no bells and whistles attached to these types of policies. They're just strictly there for getting as much coverage as possible for in an affordable way that makes sense in your budget. So let's switch gears to comparing it to permanent coverage. Permanent coverage really is more of a long-term life insurance strategy. So a lot of times people will get into temporary just for a short term, a specific duration. But when you think about permanent, a lot of people are planning for the long haul. So they're planning to pay for it until they pass away. So for their whole entire life. They're planning to pay until a specified period of time and have it paid up, where they continue the policy on, but they just pay a big amount for a specified many of years, and then the policy will continue to function and work how they're wanting it to. So you can really customize permanent coverage in a lot of different ways, utilizing various different types of policies. Like I mentioned, whole life, universal, variable. Those are just a couple different types of permanent coverages that could be customized and utilized in various ways. The premium is also fixed at the age that you enter it. So for temporary and permanent, the age that you get into it, you will pay that for the contract period. So the premium typically does not increase on you in most situations for permanent coverages. Once you get in the age you get in, you pay forever. You never have to worry about that premium going up in most situations. But the thing is that for temporary coverage, it's much less expensive, and for permanent, it's much more expensive. So in the longer time frame, usually people will get a smaller amount of coverage for permanent than they would for temporary, because it's all about budget, cost, what can you afford, how much coverage can you get for permanent. That's going to allow you to still be able to pay your bills and feel comfortable with your monthly expenses. So as long as the premium is paid consistently for a permanent policy, your coverage will last for your lifetime. So you'll have the coverage forever. You won't have to worry about it lapsing or the term ending and the contract ending with the insurance company. On the contrast of temporary coverage, permanent coverage does offer lots of different cash value options, investment components. So in some situations, you'll have a premium that you'll be paying for permanent, and then a portion of that premium will be invested. You can actually have it go to an investment account where you specifically specify the types of investments. And other times they have cash value that grows for you in the policy that can be taken out and utilized while you're living at any point in time. So there are many different other bells and whistles and features that are attached to permanent types of coverage. And then some of them offer really, really interesting riders. And some of these riders may be of interest for some people, and some of them they may be not of interest. But they offer riders like chronic illness riders. That's one thing that I will bring up. Or waiver of premium. So if you become disabled and you can't pay for your policy because you can't work and you have no earned income, sometimes the companies will waive the premium, and then you won't essentially have to pay for the coverage. Chronic illness riders function a little differently, where they help with, if you have a chronic illness, sometimes they'll help cover long-term expenses and stays in hospitals for certain situations that happen to you, and you can take from the death benefit. So there's many different components to a permanent policy that you can structure, and you can add on riders that typically aren't excessively expensive, but they can really enhance the policy and have you utilize it in a very unique way in the future and in retirement. I'll touch on one more thing. There's usually in some situations paid up features. So sometimes you can pay for a permanent policy for 30, 40 years, and then you can essentially take a decreased benefit and have it be paid up and then still have a specific amount that you'll be able to carry on until you pass away. In other policies, you can essentially structure like a 7-pay or 15-year pay or 20-pay, where you pay a bigger amount for 20 years or 15 years, and then you don't have to pay for the rest of your life. So there's lots of ways to be able to customize it for what you're looking for. Some people want to pay the smaller premium and pay forever. Other people want to pay for a shorter period of time and then not have to worry about paying in retirement and through retirement. So it's really just what fits you and your family's goals and your needs and what you're looking for specifically. So after going through the temporary versus the permanent and talking through the two major types, a lot of times people say, okay, I get that, I understand that, but which one really is best for me? How do I plan for my family? How do I think about which one should I use? How should I use it? And ultimately, it really just depends. So there's no one size fits all. There's no one particular answer. It really depends on many factors. And that's what we do, is help people really understand what are those factors and how will they affect my situation. So usually the first people think about with life insurance is the cost. How much is it going to cost me to get a temporary type of policy or a permanent? How does that differentiate between the two? Insurability is a big one. Am I actually insurable? A lot of times that can be a roadblock for people getting life insurance. The younger you are, the healthier you are, the less expensive the life insurance is, and the more probability that you're actually going to be insurable to get the policy. I mentioned earlier when we first started that life insurance companies, they look at your medical background and your history. So they look at your current state. They ask you many questions about your health. They can look into medical records. So that can actually weigh out whether or not you're able to get a policy. And there's many different companies out there, and you can always look around to see what company would offer the best rate or the best type of policy with your certain condition. And then it's really just family needs and overall goals and long-term strategy. Really, it's all about what type of coverage you want for your family. What type of legacy do you want to leave, if you want to leave one at all? And are you looking for the short-term need, or are you looking to cover the long-term? So it's really a bunch of different factors, and that's the best way to put a plan together. So when you can answer some of these questions, it'll help you narrow down the best one to look for. I'll touch on one last thing, which is just blending different coverage types. Ultimately, like I said, it depends on what you're looking for. So sometimes what people will do is they'll blend permanent and temporary. So instead of just utilizing one or the other, they'll get both and essentially give them two really strong policies that are going to function and serve them in different parts of their life. So by utilizing temporary and permanent, it provides you a huge benefit long-term for the early years while you have young children, to the years where they're growing up and they're moving on and moving out of the house, to the years where you're continuing to work, but then moving into retirement. And then ultimately you're fully in retirement. You have no dependents. You're just trying to live off of your assets and your income and things like that. So there's a really good way to do it where you have a decent amount of temporary in the beginning, and then you get some permanent to just have it. And then you just basically utilize the two to make sure that you're streamlining your goals long-term, to making sure that you're maximizing the type of coverage you'll have, so that when you do retire, you're not looking to get a permanent policy or looking for a specific policy at that stage when the life insurance is just much more expensive. Or you can just get temporary and you can convert it. So there's lots of different ways you can think about planning. There's no specific way that's perfect. And planning for a higher death benefit in the early years, when the need is higher, you have more expenses, your costs are higher, your kids are young, you have mortgage that you're currently paying down. It's sometimes easier for people to think about utilizing term because the cost is lower. But long-term, guaranteeing insurability with utilizing a permanent strategy could still be helpful to have you take advantage of in somewhat of an early year age. So it's just something to think about. Blending coverages is helpful because sometimes people think, do I have to pick just one or the other? But ultimately you can do both. There's no specific type of coverage that you're only allowed to get. There's lots of different types out there. And most of you probably have some type of group coverage, or in the past, you probably had group coverage where your current employer offered coverage and you were able to have accessibility with getting 100 to 500,000, whatever it is that they offer. And then having that type of coverage that's pretty affordable through your employer is also another helpful way to just add an extra benefit while you're in your younger years of working. So this is really it for the life insurance basics. We could go into much more detail, but I definitely want to save some time for Terry to talk about common pitfalls and just talk about the ways to get out of those pitfalls when it comes to taking a look at your life insurance policy, how to actually read the policy, what it means, and how impactful and honestly just beneficial it is long-term to continue to review your policies. Because a lot of times people will get life insurance and they'll tuck it away and then they won't actually take a look at it for maybe 20, 30 years. And depending on the type of policy you have, that could potentially be, that could hurt you in some way, but it also couldn't. So it's just helpful to know what you have and make sure that whatever it is that you have, you're updating and renewing and it's working in your best interest long-term. That way you're not stuck in a situation 30 years down the road where you're thinking, why did I get that type of coverage? How is it serving me now? Did it serve me back then? So I'll just wait here and let Terry go ahead and start up talking about the pitfalls. And I'm going to just stop my video and have him come on screen and finish this up. Hope you guys are enjoying the presentation so far, and we'll look forward to the rest of the presentation.
All right. Well, Ken, thank you very much. I've said many, many times that she is my better half, and I think it's evident for a lot of different reasons. So great job. We're going to pick up from here and talk about some of the pitfalls and the best practices with life insurance. But I did also want to take a moment and answer some of the questions that you all submitted. So thank you very much for submitting questions. So I'll take a look at the list really quick. We'll answer a couple of the questions and then we'll keep moving on, and then we'll make sure we answer all of them by the end of today's presentation. So one of the questions was, how long is a term life policy good for? I think Kenna has mentioned this, that insurance can cover you forever, but oftentimes the insurance will have a 20 or 30 or some amount of time frame that it usually covers you at a set rate. So life insurance can cover you up to age 120. 120 is the max age for coverage. Will you receive any money back at the end of your term policy if you live past term length? Most likely not, unless there's some type of dividend or there's some type of return of premium term insurance that you took out. In that instance, you would probably need to contact the insurance carrier. If there is a return of premium, they would notify you by mail, whoever the policy owner is, as long as the address on file is up to date. But 99% of the time, there's no money back, because nowadays, most people can't even buy return of premium term. It's not really economically feasible for companies to issue it. And it's also not a great deal for consumers. So there's not much of that anymore. Isn't it wiser to get whole life policy when you're young and healthy rather than later? Generally, yes. It is a great idea to get permanent insurance while you're young and healthy. You can lock in a lower premium, and then you can potentially have that premium and have it last forever. The only reason you maybe don't purchase permanent insurance when you're younger is if you can't really fit it in your budget. So what we often see is a person might get permanent life insurance in some small chunk or some amount, and then they'll just get more and more and more over time. So again, those are a few of the questions that came in. Thank you all for submitting questions. And once we get through the next portion of our presentation, we will leave room for additional questions. So as always, we're going to keep an eye on the chat box. If any more questions come in, just let us know. But without further ado, let's jump back to the presentation, and then we'll make sure that we end up by answering those last few questions. Okay, so we're now going to jump right into common pitfalls. And there are a lot of potential pitfalls out there. Just like on the road, there's maybe a lot of potholes and imperfections on the way to work or on the way to see friends and family. We're just going to focus on a few of the big ones, right? These are the ones that if you hit this pitfall or this pothole, it could hurt your alignment. It could end up doing some damage to your situation. So we're going to talk very quickly about three. Number one is just not understanding your policy, like not truly getting why you bought it, what purpose it serves, and how the factors and features will work, both short term and over the long term. Number two is not having enough coverage. We've probably all been in fender benders or had some type of damage to our vehicle. If you have insurance and it's not your fault, not super stressful. If you don't have insurance or you don't have enough, then that could be a really stressful, really costful situation. So we want to make sure we have enough coverage, and we'll just talk about some of the ways we can figure out how much is enough. Third, if you've seen the movie Bird Box, honestly, it doesn't really have anything to do with Bird Box. It's just not looking at your policy. It's not reviewing it, not updating it over time. Again, if you have a life insurance policy for 10, 20, 30 years, maybe 20 years down the road, Aunt Susan shouldn't be the contingent beneficiary because she's no longer going to be the one taking care of little Kenna, now that little Kenna is no longer so little. So over time, we want to just make sure that we review our policies, and we'll talk a little bit later about the implications and the real world pros and cons of not reviewing a policy. So the majority of our time is going to be on best practices. We're going to mostly talk about how do we do the good things, which are going to help us not do the not so good things. So we'll jump right in. And one of the things that I wanted to do was show you one of my life insurance policies and give you, like, no kidding, this is how this really looks and this is how this really works. So here's screen one. I logged into Protective Life and it says policy type, fixed premium insurance policy. If you're able to access the chat box by just looking at this screenshot, are you able to tell me what type of life insurance policy I have? So I'm going to wait a moment, see if anybody knows what type of policy it is, just from looking at this first page that tells me it's a fixed premium insurance policy. All right, I don't know if I have any takers. Probably a smart decision, because when I first looked at it, I went, well, that's interesting. We click on the view details button and it tells us a lot more. Okay, so there was an answer that maybe it was whole life. And you know, it caught me off guard. I thought maybe this is a whole life policy because it says fixed premium. But no, this is a 30-year term policy. So part of our family's financial plan and part of our protection strategy was to have some pretty substantial temporary term coverage in the event that Terry gets hit by the fruit truck while he's out running, or, you know, going to Erewhon for an overpriced smoothie or something like that. So this is a 30-year level term premium. What that means is for 30 years, the price stays the same. If you look a little further, you'll see at the bottom, the price is about $100 a month. So there you go, simple and plain. For 30 years, every single month, the price is the exact same. A few things to pay attention to. On the screen, there's an expiration date, which is October 7th, 2085. Who knows how old I'll be then? Very old. No, that's not 120, but you know, I won't be doing marathons anymore. But one of the more important things to look at is this term conversion expiration date. One of the beautiful things about term insurance, you purchase term and later, with no questions asked, convert it into whole life, universal life, or some other type of permanent insurance. This tells me that 2039, that's when my conversion period goes away. So if I want to upgrade my quality of my coverage from term or temporary to something else, you know, I've got 7 to do it. So that's an important thing to keep an eye on. Other than that, those are some of the big factors that we'll kind of start with. I wanted to dive into one of the scary pages that you sometimes see. And I broke it down in a couple different screenshots. So again, for 30 years, this policy has one price. The price stays the same, doesn't move at all. So it's pretty boring. $1,184 a year after year after year after year. That works out to about $100 a month. So at the end of 30 years, the price is going to increase. Let me say that again. For 30 years, the price is very boring. It stays the exact same. And spoiler alert, after 30 years, I'll be in my 60s. Look what happens to the price 1 year after my policy level period ends. The next 7 years, the price goes up by $4,000 a year, and then up by another $12,000 a year, then up by another $7,000 a year, and then $5,000, $8,000, another $8,000, another $8,000. So from year 30 to year 37, the price increases by 50 times. It goes from $100 a month to $5,000 a month. Now, if you're good at math, it's not actually $5,000 a month. It's probably closer to $420 a month, but work with me. So just think about that. If you have term insurance and you're comfortable with your $100 a month, did you realize that in 30 something years, it's going to go to $4,000 or $5,000 a month? That would be good information to know today so you can plan for the future. Are you going to convert? Are you going to do something different? So again, this isn't a trick. This isn't a bad policy. This is actually a phenomenal policy. But remember, conceptually, you start the policy super cheap. It stays level, very cheap, and then it goes crazy. And within 6 or so years of my level period ending, I'm paying 50 times as much for my policy. Now, that's crazy enough to pay that much for life insurance when you were paying such a little amount. But let's go a little further. If we just keep looking at the years going by the time I'm in my 42nd year of the policy, I'm paying $100,000 a year. By the time that I reach age, let's see, if I reach age, I had to do some public math, age 80, my policy is $232,000 per year, almost $20,000 per month. Is there anybody on this call or in the world that wants to pay $20,000 a month for life insurance? Frankly, there are some people in the world that do want to pay that. I would suggest that most of us on this call, maybe not, but in some circumstances, maybe it does make sense. That would be really interesting estate planning for higher net worth individuals when you would consider such a thing. But for most of us, again, going from $100 a month to $20,000 per month, not going to happen. We don't want to do it. If I live to be 92, congratulations, I pay $1 million a year for my $2 million of life insurance. So Kenneth said earlier that when you think about term and permanent insurance, people focus on the cost. The funny thing is, if you buy permanent insurance, you're paying a higher amount to start with. But if you look at them net over a lifetime, considering this, the permanent insurance costs you a heck of a lot less, and you know what you're paying and you know for how long. Whereas the temporary coverage starts out really cheap, but then it goes up and up and up and up. It's almost like those Black Friday sales where they say, hey, 90-inch TVs, $100. You get to the store and they say, sorry, we sold the one we had. The other 1,000 of you can buy our 90-inch TV for $4,000. Congratulations. So again, this isn't a trick. This isn't a scam. This is just how life insurance works. And it's based off of actuarial science. And this is how a policy looks. A couple quick things to just kind of wrap a bow on the case study of understanding your policy. With life insurance, there's all these factors and features. One thing I often talk about is incontestability. The long story short is you should be very honest when you apply for life insurance, but let's say you're not. Let's say they don't disclose that they have a life-threatening condition, and a year into the policy, they pass away. The insurance company's not going to pay that $2 million. They're going to say, within this incontestability period, we found that you misled us. And as such, your family doesn't get $2 million. However, they do get back the premiums you paid us. Here you go. Now, Let's say you live 2 years and 1 day. You can lie to all you want. It doesn't matter. The insurance company has to pay the death benefit. So that's just an important thing to know. We never want to think about the fact that someone may not make it the 2 years or that they may plan to not make it the 2 years, but it's a no kidding rule. Less than 2 years, that money may not go to your family, but 2 years and 1 day, hey, you're good to go. Now, if there is a misstatement of age or sex, or there's a change later, they'll still pay the policy, but instead of your $100 getting you 2 million, they'll adjust the face amount based off of the misstatement. So if you were actually 2 years older than you said, maybe instead of 2 million bucks, your family gets 1.9 million. So again, just know that there's incontestability clauses and other things within the policy. But generally, if you make it 2 years and a day, the biggest risk of not disclosing goes away. Again, the insurance companies are pretty smart. They're going to find out most information anyways, but I always tell people about the 2-year policy period, just so that no one is confused if they did get the policy under a situation that wasn't fully transparent. They know up front, not going to work. So for more information, and I don't know if anyone in the history of finance has ever used FMI, but I thought for more information, there's this thing called the Life Insurance Buyer's Guide. It's only 3 pages long, and it walks through some pretty good considerations about life insurance. So if anybody does want one, let us know. We'll email it to you. It's super simple, but it goes through some questions and some considerations to make sure that you're looking at and analyzing a policy that might be a good fit. And of course, as Kenneth said, that's what we do as well. We help people make great decisions about protection strategies. We're agnostic about the company you use or the particular type of product. And with the 4 advisors plus Lisa, our in-house licensed insurance specialist, we're here to serve and happy to help. So that was question 1. We spent a lot of time on question 1, which is understanding your policy. I could go on that forever because at work, you may have a policy, through a labor union, you may have a policy, and they're interesting. The other day, somebody told me, hey, Terry, I have 500,000 of coverage at work. It's 100% free. I said, no, it's not. Companies can typically only give you $50,000 of coverage for free. Above that, they have to bill you, and they bill you by something called imputed income. Basically, you pay it by deduction on your payroll. You don't even know it, but it's on your pay stub most likely. So again, there's a million things about understanding life insurance we could talk about. I'm going to finally let that train leave the station, talk about how much insurance. If you know me, you most likely think that I'm not a super pushy person. Kenna, she may disagree. Just kidding. She thinks I'm okay. But with life insurance, how much is enough? It's really about you. With life insurance, you have the opportunity to choose your legacy. You have the opportunity to design and hold a contract that's going to provide the type of legacy or pot of tax-free money you want to leave behind. Since I was in my early 20s, I chose that if I were to pass away, I wanted my loved ones to get at least $1 million. Why? Do they need it? Maybe, maybe not. But I don't want to leave this earth, and early anyways, but if I did, I felt better knowing that the people I love were going to become overnight millionaires. Now, fast forward to I'm married, I have a child, we have a second one on the way. The amount of coverage is really important, and that continues to change over time. So how much is enough? Again, think about the legacy you want to leave and answer some basic questions. In the event that you died prematurely, do you think your spouse or others you care about would want the peace of mind of a mortgage-free home? Would you want to extinguish all the debts for them so they don't have to worry about servicing those payments? If you have children or grandchildren, do you want to pre-fund a lump sum that could be used to send them to college fully paid? Are there other big goals that you want? Send the whole family to Disneyland. Send them all to Iceland. What do you want to do? Do you want to pre-fund wedding expenses for a child? So again, paying off debts, providing a lump sum for some type of goal, those are some of the big ones. But then the biggest, most important is ensuring there's enough income to help your survivors continue with life. It's not about getting rich. It's about replacing an income to help support a family. So think about that. We have two people, one goes away, we've got half as much money. Maybe we have 90% less money. It depends on the situation. And I got to tell you, Social Security is not going to help much. Unless your children are young, surviving spouses don't get anything until they're at least 60. If they're still working, they may not get anything. They can only make like $20,000 a year. And every dollar they make over that causes their benefit to get reduced and eventually disappear. So this is serious business. Again, do we want to pay off debts? Do we want to fund goals? And how do we replace the income we're no longer there to provide with some pot of money that's going to be as reliable as possible when we're no longer here? So the last thing I would say about life insurance is it creates this bucket of money that you decide. It deposits it to the people you care about at the exact right time. Oh, by the way, it's not impacted by the stock market like your portfolio is. So if you're just self-insuring and leaving behind your big portfolio and the market's down like it is now, do you want your family having to sell shares of their investments at a discount and not be able to keep that money invested for the upswing? Or would you rather, again, have a pot of money, an asset that's not tied to the market and that's going to be super reliable and tax efficient? It's up to all of us to think through these things and figure out where it fits into our plan. But hopefully that gives some insight onto how much is enough. And if you have trouble with it, we have worksheets, we have software, we can help you figure out what the number is. So I would say the right amount of coverage is paramount. After that, the right type of coverage or the quality, that's secondary, because in the event of a death, doesn't matter if you have term or permanent, pays the same. You want to have enough coverage. So I'll end that there and we'll go to the last portion, which is policy review. I searched high and low for some type of clip art that was cool. This is the best that I came up with. I don't know that it's cool, but it looks like he's inquisitive and he's searching for something. He's looking for his insurance policy. It's in the safe somewhere. We moved 3 times. Who knows? It's in a box. But when he finds the insurance policy, I would just suggest that he checks beneficiaries, that you check who the policy owner is, that you make sure the address is correct, the phone number is correct. You just want to make sure that all the relevant information is up to date. We've seen situations where a person passes away, and because they never changed their beneficiary, the money goes to their parents instead of their spouse. It goes to their ex-spouse. It goes to their brother and sister. And that becomes this whole thing that you don't want to get into. So suffice to say, very important to review your policy. And that's just for the administrative stuff, to make sure it's working and that your beneficiaries are correct and that everything is fitting your intention. Maybe it's supposed to go to your trust versus going to someone else. Maybe it's going to go to charity. Maybe the charity no longer exists. You got to update your beneficiaries. There's all these things that you can look at. And then again, depending on the type of life insurance policy, you may want to do a health check to ensure that it's going to be okay over the long term. Now, the concept of a health check of life insurance, most people are probably like, what does that even mean? And I'm going to take a moment and kind of talk about that. Kenneth said earlier, there's a lot of different types of life insurance. I'm going to spend a little time and we're going to peel the onion talking about universal life, because universal life it's like the Baskin Robbins of life insurance. There's at least 37 flavors, the variable or the index or the survivorship. Those are like the big flavors, the vanilla, chocolate, strawberry, but it goes way beyond that. So let's think about universal life insurance and let's just think about it as a bucket. The reason I think about it as a bucket is because with term insurance, people think it's throwing money out of the window on the highway. You're just paying your premiums and you're never going to get anything back unless you don't live 30 years, but you're just throwing it away. But with whole life or universal, you're paying premiums, but later you're going to get some of it back, maybe all of it, maybe more than what you put in. So it's almost like you're putting money into this bucket. Now, from this view, the bucket looks pretty secure. Maybe metal, probably makes a cool sound. You can play the drums on it. Safe, secure, great, solid. But you got to really inspect your bucket because not all buckets are created the same. In some instances, universal life policies are going to have holes in them. What do I mean? So again, let's talk about this super big picture. When you buy a permanent insurance policy, they'll usually say, this is your premium, you pay this every month, this will stay the same forever. So let's consider a $100 universal life policy. So let's say you're 25 years old when you buy this. You get this amount of coverage, they say it's $100 a month. When you're young, your life insurance costs are probably pretty low. So what they actually do is you're paying them $100, they're going to take $10, pay for life insurance within your policy, that's called COI, cost of insurance, and then that remaining $90, they're going to take some fees and whatever, but then the remaining amount's going to get put into your bucket. So then next year, you get a little older, you pay $100 a month, they take a little bit more, they pay for your insurance, they pay for the fees, and they put it into your bucket. So for these years and years and years, they're putting money into your bucket. Here's the important thing to keep in mind. As we get older, the cost of insurance goes up. Cost of insurance and what you pay to the insurance company, completely different things. Again, the cost of insurance is the internal mechanism that dictates the price per thousand of coverage for the certain year or the certain age that you are. So it may start at $10 and you're putting $90 into your bucket, but as you get older, your cost of insurance is $50. Now only 50 is going to your bucket. And then it's $100 and then zero is going into your bucket. You live long enough, which you don't have to live that long. Instead of money going into your bucket, they now have to take money out of your bucket because you're only paying them $100, but your cost of insurance is actually $300. Remember I showed you earlier that with my life insurance policy, it's $100 a month now, but as I get older in my 60s, it's $4,000 a month. So that's what's happening here. Within permanent life insurance policies, sometimes the amount you're paying them isn't enough. So as you get older, they're drawing money out of your bucket, out of your bucket, out of your bucket. So what happens? Again, period of putting money in, your bucket's growing during the green, it hits the break even, and then during the orange, you're now draining your bucket. So here's the picture. We thought the bucket was sturdy, it's full of holes. The holes are the cost of insurance, the administrative fees, all the other things that happen. So look at this bucket. Will this bucket ever run dry? Will it ever run out of water? It might. And that's the sad news for universal life. Depending on your policy, you can pay for it for 20, 30, 40 years. You live to be 73 and you get a phone call. Hey, your cash value has been depleted because we've been paying your premiums with it because what you were paying us wasn't enough. You've got two choices. Pay us more or say goodbye to your policy. That's bad news. And that happens to people every single day. Lots of people. So again, not saying you should be worried, not saying you should be concerned, but if you have a universal life policy, as an example, and you don't know for sure if it's guaranteed, I would suggest that you have somebody take a look at that. And I happen to know a few people who would be happy to help you understand your policy. Because if it's one of these policies with big holes that are getting bigger and bigger over time, you may want to abandon ship before the hole gets too big. Like we're planning to sail out from California to Hawaii, but we've spotted this hole in the boat. Rather than trying to get there and, kind of bucketing the water out as it comes in, let's just get the boat fixed. Better yet, let's just, sell that boat for $1,000 and get a new boat for $1,500 and let's get across to Hawaii. That's a long way on a boat, but you catch my drift. So again, this is just a very simplistic thing that's working within permanent insurance sometimes. And if you don't know, it could hurt you. So hopefully that gives you a little bit of insight and just a little bit of information about what happens beyond the cover layer of how life insurance works. So in summary, we talked about life insurance basics. We talked about some of the pitfalls, and then we talked about how to avoid the pitfalls. Again, being planful, understanding your policy, reviewing it over time, and then just making sure that you have the right type of coverage, enough coverage, the right quality, and that what you purchase and utilize as a protection strategy is aligned with your goals, risk sensitivities, time horizon, family situation, etc. So That's the end of our formal presentation. I'm going to leave this slide up for a moment that just has our contact info. You know, you can page us, beep us, reach us all sorts of different ways. I want to pull up those questions, and then I will put that slide back up with our contact info. I don't have both my screens open today. So let's go to our last few questions, and then any other questions you have, I'm happy to answer. We're on time for once, and that's because Kenna did the first half. So term versus universal versus whole life for those over age 60. If you made me pick any of the three, I would say universal life. Unless you're a person with lots of assets and your goal is to utilize the whole life as some type of investment that you're going to overfund it using a participating life insurance policy. Other than that, universal life is probably going to be the way that you want to go, unless you don't want to be guaranteed that the policy is going to pay out. You can buy term for 10 years or 20 years or maybe even 30. But what you got to keep in mind is if you live too long, not going to work. 95 to 99% of term never pays a death benefit. So if you want to ensure your family gets something, has to be universal, has to be whole life, should be guaranteed. That's the way that you should play that one. Are there times when term is better than whole life? Short answer, if you need a lot of coverage and you don't have a lot of money in your budget, term's better, without a doubt. You can always convert that term to permanent if it's doable within your policy. So any reputable advisor who does planning will tell you quantity first. Get the right quantity to protect your family. That's term. If you can afford the whole life with a permanent insurance, great. If you can't, let's find ways to make it affordable in your budget and to add bite-sized chunks that are going to be meaningful over time. Should you get life insurance for a baby or a child? Probably yes. I don't like to give blanket answers to things, but in the event that something happens to a child, most people would struggle to come up with the money to pay for it. We don't want to have GoFundMe's and these terrible things to remind us about how bad of a situation we had, or to have to pay a funeral home every month for 6 years. You know, it's extremely cheap to add a child rider for a few dollars a month to protect all of your children in your household. So Kenna's policy has a child rider. Any children we have or adopt, good to go. They're all covered. And they can even convert that child rider to their own policy. Further, you can buy your kids. You can buy them when they're about 2 weeks old. They can have that policy forever. It ensures their insurability. They can get more coverage in the future, no questions asked. There's a lot of great features. I will caution you, you probably don't want to buy life insurance for your kid and use it as a college savings plan. That's a terrible investment. People that advertise that, no, run away, don't do that. Not a good deal. Last question, should you borrow against your life insurance? That's a good question. Short answer is maybe. Here's why I say maybe. If you have a whole life insurance policy, you can borrow from the cash value, but there may be an interest rate associated with it around 6 to 8%. So ask yourself that. Is 6 to 8% interest more than you would want to pay in interest? And for depending on your situation, 6 to 8% is maybe not that good. So maybe you don't want to borrow from a whole life policy. Maybe you'd be better off doing something else. Now, let's think about a universal life policy. Depending on the universal life policy, you can sometimes borrow at a rate of about 0.02%. So almost free money, and all you have to do is pay back the interest. So again, with a universal policy, you can pay an interest rate of a fraction of a percent, like 0.02%. Should you borrow from that? Probably. That's really cheap money. The downside is when you borrow the cash, when you pass away, it then lowers the amount of death benefit that goes to your family. But using life insurance in a tax-free fashion, specifically universal, most likely instead of whole life, can be a tax-efficient way to have tax-free income and have a tax-diversified strategy as a retirement income plan. So great question, short answer, maybe yes, most likely better if it's universal, not whole life. That's the bottom line on how policy loans work. So great questions. Appreciate you all submitting questions in advance. And I think we were able to answer all of them. So we are at the end of our formal presentation. If there's any questions you have, please type them in the chat box. If you're really quick, send a carrier pigeon. I'll grab the note and read it, and we'll go through it together. But if there are no other questions, that is the end of today's presentation. As always, we appreciate you spending some time with us. Feel free to connect with us on innovativewealthbuilding.com. Email us at yourteam@teamiwb.com. Our phone number, our social media, Facebook, Instagram, LinkedIn, someday TikTok. We're all over the place, and we're here for you. And we want to continue to do these things just because if it's just one little thing you pick up that you can share with someone or just keep for yourself, then we consider that time invested, not spent on our behalf. So I'll stand by to see if there's any other questions. But if there's not, you're very welcome. Thank you for coming. Have a great day, and we will see you next time.